Good afternoon. I wanted to catch up with you guys. There's been a lot of talk about the recession this year. In fact, we've seen GDP come down for a couple quarters, and by textbook definition, a lot of economists are saying that we are in a recession. However, if that's the case, we're in a very unusual time period. We've never seen this happen in a recessionary period necessarily. Typically, when we see a recession forming or we're in a recession, we see a decline of GDP and an increase in unemployment. However, this time, right now, we're watching unemployment numbers drop and GDP has come down a little bit, yet corporate profits, which are normally, or corporate margins rather, which are normally single digit right now, maintain a double digit return. So it's a really interesting time period in that we're not following suit with any other recession that we've seen really since World War II. And that brings into question whether or not we really are in that recessionary period. Now, the market seems to be pricing in a recessionary event. We saw the market recover a little bit of its losses from July through August, and then started to fizzle out, and then that became exacerbated by the Fed's comments after their retreat. So where are we at? What's happening? Are we really in a recession? Is this really a bad time period? And so we hear a lot right now talking about participation rate in the labor market. And the participation rate has been declining actually for over 4 years now. In fact, right now, the last reports that just came out this week, right before this video, there's roughly just over 11 million jobs that are remaining unfilled. And yet unemployment remains low. So are people just not going back to work? Contrast that to 2019. In 2019, when the economy was thought to be running full and that we were in a really good economy, we had 7 million job openings. So we really only have 4 million more job openings now, roughly, than what we had even then. So the participation rate has continued to decline. But it's not because people aren't necessarily going back to work. We've seen a record number of baby boomers retire. In 2020, the number of baby boomers that were entering into retirement, age 55 to 64, increased exponentially to the prior year in 2019. So we saw 3.5 million, roughly, more baby boomers retire that year. So it's interesting, you know, we're saying that there's roughly 4 million job openings more now than what there was in 2019, and that number seems to equate out to the number of people retiring. So we're in this interesting dynamic. Corporations are sitting a lot of cash, roughly about $4 trillion in cash. Unemployment remains low, and corporate margins remain in double digits. So if we are in fact in a recession or moving to a recession, we're not seeing the normal things that we would normally see during a recessionary time period, at least going back to World War II. So what does that mean right now for today's marketplace? Well, the economy, on a lot of measures, looks to be doing well. We got good reports on inflation this last month. It looked like the inflation had actually come down on the last report that we just received. We'll see what September's report looks like. And if that follows suit, that should bode well for the marketplace. Also, too, remember that we're rolling into an election year. Election years tend to have some volatility going into the election, but then oftentimes will rebound on the back of the election. So it's possible that we still see that happen. There's a couple different schools of thought out there. So if you're watching the television and stuff like that, you're going to hear people saying that we're headed down even lower. Some people are equating this time period to 2008, where we had a little bump upward in August of 2008, and then we sold off even deeper than what we had before. Although I would tell you that I don't think that the dynamics of today's marketplace and today's economy are the same as what they were back then. So careful thinking that this time is exactly like the last. We are in a different paradigm. And so in that light, the other school of thought is that we're in a similar situation to what we saw in 1982, where the Fed remained aggressive in raising rates, trying to control inflation, and the market rebounded long before the Feds slowed down raising rates. So those things are yet to be seen. But the interesting thing, and the thing that I want you to focus on, is if you look at how quickly the market started to rebound in July through August, it was a pretty sharp uptick. In fact, we recaptured roughly almost 9% of our losses for the year. So that's a good indication of how quickly the marketplace can move. And that was really happening on some shaky information and some assumptions made about the Fed Reserve and whether or not that they would stay aggressive with interest rate increases. The idea was that they would slow the interest rate increases, maybe before the end of the year, and possibly even cut rates in 2023. So the market seemed to be very surprised by the fact that the Fed came out after its retreat with a very hawkish tone, meaning that they're going to be very aggressive with trying to slow inflation down and continue to raise rates. I think that's interesting considering that's been their tone for quite a while this year. So the idea that they were going to slow down that process may have been a bit premature, and that caused a little bit of a rally. But that doesn't mean that the market can't still move positive for the year, even if they are remaining aggressive. So I think the indicators and the things that are going to help the market figure out a path going into the end of the year here are going to be what the readings on inflation are in September coming up and through the end of the year. And then what does the overall economy look like? How are corporations doing? How are earnings looking? We have a lot of really good companies out there that have been sold off indiscriminately because of panic selling in the marketplace. Now, there's a lot of people that are yelling that this year is going to be a negative year. There's a lot of people yelling this year is going to be a positive year. Some of the things that we have gotten right so far have been, we did start to see a slowdown of inflation. We'll see if that continues. If you remember last year, I said I thought we'd start to see a slowdown in CPI the second half of this year. So we're waiting to see if we have confirmation of that being correct. Earlier in the year, I was incorrect on a couple things. I thought we'd actually see this market bounce and move back to the positive earlier than what we have. But I maintain that we could still potentially have a positive year. In fact, there's some pretty good evidence that that's very much likely the case, but we can't say with 100% certainty. So I'll go back to one of the things that I've always said. If you've been with us for quite a while, I have told you, we will have a negative year. Those things are inevitable. It's easy for us to get lulled into a sense of peace, if you will, when the market is moving up consecutive years in a row. We had some really good returns, 2019, 2020, 2021, all back to back. And it's really easy for us to get lulled into that and thinking that those times are always here to stay. And then we have a time period like this that rattles us a bit. But remember, it's not necessarily about how you time the market, rather how much time you spend in it. In fact, most studies show that as long as we remain invested, we actually come out better on the other end of it than had we made a lot of changes throughout it. But we still make some changes. We want to make some adjustments to stay on course. So we're going to continue to watch this situation. We're looking for September's numbers on inflation. We're looking for corporate earnings. What do they look like? And we're looking at unemployment. And we're watching those numbers very closely. So again, if we are in a recession, it is not like any other that we've had since World War II. This is a very unusual situation. By textbook, you could make the argument that yes, we are there. However, the U.S. has never really used just the textbook definition of two or multiple quarters of negative GDP growth. So we're in this interesting situation. We have a lot of baby boomers retiring, so we have a lower participation rate in the workforce. We've had a lot of stimulus come into the economy. That has spurred demand. And we have wages that are continuing to increase at one of the fastest paces that we've seen since the 80s. So all of those things factor into the inflationary drivers. But I would tell you that I think that if we look at most of the inflationary drivers right now, we could probably say that they're starting to or have pretty much dried up at this point in time. So it'll be interesting to see how long inflation actually sticks around. You know, originally the Fed had said inflation was transitory. They didn't say that to be cavalier on the economy. In fact, most people thought inflation was transitory. And the reason being is anytime we come out of a period of economic turmoil, we always have a disparity between supply and demand. And so inflation does go up short term and then pull right back down. Although this was a different time period. Like I said before, we've never actually taken a fully healthy economy, shut it down, let people stay at home and continue to earn money, and pumped money into the system and then flipped the light switch back on. We've never done that. And so this time period has the nuances that are different than stuff that we've been through before. So again, can we say that we're in a recession? Nobody really knows for sure. But the reality is that the marketplace and these companies still remain very healthy. We have, like I said, companies right now are sitting in close to $4 trillion of cash. That's not an unusual event in an economic slowdown. Unemployment remains very low, and yet there's still a ton of jobs out there that need to be filled. And so even as you see companies start to report that they're laying off people, we're seeing jobs being filled on the back end of that very quickly. So unemployment may not tick up with companies laying off people unless we get a broad economic type layoffs situation. So we'll continue to watch this. We'll continue to look at what's happening. There are opportunities in this market. Volatility creates opportunity for us. And sometimes it's easy for us to forget about it because we're watching the value of something drop. But if we look at it and we look at these companies that have gone on sale, so to speak, there's a lot of opportunities out there. We're going to take advantage of those. And so we're going to look for those indicators. We're going to look for confirmation that the market has in fact hit its lows and started moving back up off of that. And it could be well before the Fed is done raising rates. So I appreciate your patience. I appreciate your trust in us. We don't take these things lightly. We're watching this on a regular basis, and we are always looking to do what's in your best interest. If you have questions about your own accounts you need to visit with us, please reach out to us. If we haven't already talked to you, we will be reaching out to you going into the end of the year here. And we look forward to talking to you guys soon. Thank you for your time. We appreciate you allowing us to help you through this time period, and we appreciate your trust. Again, we'll keep our eye on everything, and we'll keep you up to date as information comes available. Have a great day.